Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome to the channel. In this video, we're diving into cash-only retail chains and why many investors choose to avoid them. We'll break down the risks, red flags, and what to look for if you're thinking about investing. Let's get started. A cash-only store can feel simple, even old school. You hand over bills, you get a receipt, and you're out the door. For shoppers, that can be fine. For investors, cash-only retail chains can raise a different set of questions, ones tied to growth, margins, risk, and trust. This isn't about saying every cash-based business is bad. Some local operators run tight ships and do well. The concern shows up more often when a retail chain scales up, reports results to shareholders, and still relies heavily on cash-only transactions across many locations. The bigger the footprint, the more chances for small problems to turn into expensive ones. This article is general education, not personal financial advice. If you're making a buy or sell decision, consider talking with a qualified advisor who can weigh your goals and risk tolerance. Why cash-only retail chains can be a risky investment. When investors buy a retail stock, they're betting on repeatable results. They want steady sales, clean books, efficient operations, and growth that doesn't depend on luck. Cash-only models can work against those goals, even if stores look busy. Think of a convenience store chain or discount shop. If it only takes cash, it may lose sales from customers who pay by tap-to-pay or phone wallet. That's not just about preference. It can change how much people buy. When customers can't pay the way they want, they often buy less, or they leave. Cash also adds friction behind the scenes. A chain has to count it, store it, move it, and deposit it. That takes time and staffing. It also creates more points where money can go missing without being caught fast. For a single store, a sharp manager can spot issues. For 200 stores, it's harder. Public markets also punish surprises. If a chain later reports higher shrink, a bigger theft issue, or weak controls, the stock can drop quickly. Investors don't just price in today's profits. They price in confidence that the numbers will hold up next quarter and next year. Cash creates blind spots. Shrink, skimming, and messy records. Cash is like driving with a fogged windshield. You can still move forward, but you can't see clearly. With cash-heavy stores, shrink, lost inventory, can hide in plain sight. Some loss is normal in retail, but cash handling can make it harder to tell what's theft, what's damage, and what's just bad tracking. There's also skimming risk. That can mean an employee pockets cash before it hits the register, or a manager adjusts daily totals. Even if most staff are honest, a chain is only as strong as its controls. Weak controls can lead to restated earnings, surprise losses, and painful audits. Messy records can show up in other ways. Inventory counts might not match sales patterns. Promotions might work on paper but not in cash in the bank. If a chain can't connect units sold to cash collected with high confidence, investors have a problem. They can't judge store-level performance. Handling cash also costs money. Counting drawers, preparing deposits, and resolving overages and shortages takes labor. Add armored transport, safes, cameras, and training, and margins can get squeezed without a clear way to fix it. Now you understand the challenges cash-only chains can pose for investors. In Part 2, we'll explore safer alternatives and how to do quick due diligence to spot retail stocks that are more transparent and growth-ready. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.